Hey everybody, welcome to another episode of This Week in Startups. I'm your host, Jason Calacanis, and this is an All Ask Jason episode. And we're going to focus on legal issues. If you have a startup and you don't get your legal stuff set up properly, it's going to be a disaster later on. You have to pay attention to the legal issues. You cannot wing it. Because if you do, trust me, I've seen people wing it. I've wung it myself. Bad idea. Cleaning up legal issues is so costly and so much drama that you want to get it right from the beginning. So getting it right means having a great attorney, and I have my attorneys with me. Wilson Sonsini is here. That's the number one law firm in the startup space. They've been doing it forever. Larry Sonsini is a very famous guy who was Steve Jobs' attorney and Larry Ellison's attorney. It's basically like the top firm in the Valley. And I have Rachel Proffitt and Todd Carpenter with me. Welcome back to the program.
Thank you for having us.
Nice to meet you.
Thanks for doing this again.
Absolutely.
So Wilson Sonsini's got hundreds of attorneys. Thousands or hundreds?
About 700.
Hundreds.
Yeah, hundreds.
Hundreds, 700. And you specialize in startups, but you do other stuff.
Yeah,
Tech.
Our core focus is on technology companies. So we represent technology companies from early inception through being large multinational companies. But the core is focusing on technology growth companies.
Right. And you two specifically work here in San Francisco doing startups mostly.
That's right. So we opened an office in Soma for the firm about 3.5 years ago with the desire to really support the startup community up here. And again, we want to grow with our clients. So it's not just about early stage startups, but we really want to support that aspect of the community.
Yeah. You guys lose money on these early stage startups, I think. The amount of time you put into them with the hope that, hey, some of them survive and get bigger and get to their B rounds or C rounds.
It looks good, like an investment, probably.
Yeah, that's certainly true. It's a for us, the important thing is building a long-term relationship. It's not about a single transaction. So we really look long-term and are fortunate to work at a firm that buys into that and realizes that the long-term investment is really worthwhile.
I know it's been great for me because I refer a lot of my new companies from the incubator to you, and you don't crush them with the bills, which is always important when the companies only have $25,000 or $50,000 in their bank accounts. All right, so we asked a bunch of founders, both from my portfolio and from the superfan list and on Twitter, for really tough questions. I'm going to go through a couple of questions here, and I'm hoping you can give us really candid responses to these. The first question came from James, and he said, when bootstrapping a startup, what are the legal must-haves? And then what can wait?
We get this question a lot because, as you said, companies are cash-strapped and don't have an endless legal budget. And the two core things that I advise all of our clients to focus on are intellectual property and capitalization. So with respect to intellectual property, it's not necessarily filing patents or copyrights or trademarks. It's about making sure that the core IP has been assigned to the company.
And when you say that, assigned to the company, it's assigned by the founders, right?
Correct.
And so what's the typical mistake that, because I run into this a lot, is the typical mistake that the founders may, if things don't work out, sue each other for who owns the idea, or the previous employer if they worked on the idea while they were still working at Google or Facebook,
right.
That kind of stuff?
Those are the two core issues. You're exactly right, that it's either a prior employer says you worked on this on our time using our equipment, so we own the idea, or people part ways and somebody says, I was part of preparing that business plan, so I own part of the company, which ties into the second thing that I think is really key for early stage companies to focus on, which is capitalization. So the allocation of the equity and making sure that you document that really well. I mean, we're all very aware of many stories of back of the napkin promises for half of a company that can really come back and be a real pain in the butt down the road. And as you said, it can be very, very expensive to address it then. So I think making sure that the IP is assigned and that you properly allocated and documented the equity purchases.
How do the founders have this discussion, Rachel, when they, you have 2 or 3 founders? How do you advise them to have this difficult discussion? Because I know some founders are like, yeah, they seem almost like they want to avoid the difficult discussion of who has how much, and how do you advise them to talk about it?
Yeah, it's a good question, and honestly, you're spot on, and often that's a red flag for us when they're afraid to have that conversation with each other. And sometimes we end up acting more like therapists, right? We're going to give you some talking points. You guys need to go and discuss this with yourself, and you really do need to do it now because it's sort of like ripping off the Band-Aid. Worse would be if you guys continued to work together for 3, 6, 9 months, developed a lot of IP, and hadn't reached an agreement, because that's when things get fractured and that's when the disputes arise. So we can give them talking points, often we do, and send them away to say, hey, what are your roles going to be? What relative contributions are you going to be making? And try to get them to coalesce around an answer.
It's also up to the investors to make sure that this is done right, isn't it? Like, as part of the diligence, when I'm investing in a company, I should make sure that all the IP has been assigned before I give them the money, and that they've all agreed to vest their shares.
Yeah, that's exactly right. And we actually end up using often investors as the catalyst, which is no one's going to give you money until you've cleaned this up. So kind of go and reach an agreement, have your house in order, and then folks will be able to look at you and say, this makes sense. And yes, your other point is spot on, as you know. No investor is going to want to give money to founders that are fully vested, because that means they can take the money and go sit on a beach and not be incented to go build the business. And so we do try to counsel founders to self-impose some vesting so the investors don't come in and put something potentially worse on the founders.
And the standard for vesting for founders is everybody who is in the company is going to take a year cliff, 12 months before they get any equity, and then vest monthly or quarterly after that.
Exactly.
Should a founder be nervous, like if there's 3 founders, that, hey, they might get to month 11 and get kicked out and have nothing in their own company? Does that ever happen, and should they be concerned about that?
I think if they are concerned, that's something that they should address up front. And I'm personally comfortable with monthly vesting up front for founders. I think what you propose is standard for Silicon Valley for every other employee. I can get comfortable with the founders having straight monthly vesting, especially if they're giving up good jobs, potential other opportunities, and a lot of opportunity cost in joining a startup. So I feel like if someone is willing to go all in, oftentimes they're not getting a salary, that starting vesting on day one when they're really 100% committed to the company is a reasonable compromise to address that issue.
So that's something founders could discuss with their investors and attorney and each other, which is, hey, we could make the first year cliff 6 months instead, or we could do it quarterly or monthly. Is there some difference between quarterly and monthly? Is there some standard there that's emerged?
I think pretty much it's monthly, especially for young companies, because each month is sort of critical, right? 3 months gaps can be a lifetime for companies. So I think usually folks have settled on monthly and leave it at that.
Okay, let's talk about the next question, which is obviously related. This early stage fundraising has to be done properly. And there's obviously a big debate. And this question comes from Lauren. What's better? Should I sell a convertible note, or should I do a Series Seed stock? I guess a priced round is what we would call it in the business. What's your take on that?
We obviously get this question a lot too, and frankly, your insight's going to be equally valuable to the group here. I think before the days of Series Seed, right, when that was sort of institutionalized, and now there are these open source documents out there in the world that when folks say I'm selling Series Seed stock, we all know what they're talking about, which is pretty much a liquidation preference and not very many other rights and preferences that would be typically associated with a Series A. Before that, the delta between, do I want to go through the whole rigmarole of selling Series A stock and negotiating all that, or just doing convertible notes, there was a pretty big divide, cost, time, energy. And so a quick infusion of capital for something less than $1 million, everyone sort of trended towards a convertible note. Now that we have this other alternative, right, which is a Series Seed, really slimmed down preferred stock, and now that notes have a cap on them, right, you kind of are talking about the same thing, right? You're going to have a quick infusion of capital. You either are going to put someone on your cap table as a note holder or as a stockholder, and it really just comes down to preference. In some regard, there has been some, and this is slightly tangential, there has been some question about, is convertible debt really the best thing for a young company when they don't know how their progress is going to go, if they're going to really be able to make it to market, if they're going to be able to achieve those milestones, because convertible notes, by definition, have that ticking time bomb associated with them. Right. As a result, convertible equity is something that we talk more and more about, which is effectively exactly the same thing, but for the fact that there's no maturity date on it.
Right. So the loan of a convertible note becomes mature after 18 months typically, or 24 months?
Sometimes 12.
Sometimes even 12, which means there has to be a hard discussion between the investor and the people who are running the company and say, hey, we can now, either you pay us back, we can call the note, and we could own the company before close.
Exactly.
That never happens. Have you ever experienced that happening?
Not with folks in this ecosystem.
Yeah.
But when and frankly, I just had a company who took money from, we'll call it another jurisdiction, and actually the investors did decide to foreclose and hold the asset. I mean, that's obviously a travesty, and everyone is traumatized and they've lost their company, but it doesn't really happen here, right? Folks know the game pretty well.
I think that's something important to highlight is the benefits that we get through the startup ecosystem, whether it's here or Santa Monica or New York. People, geographies where people really understand this type of investing. I don't think that you can underestimate how valuable that is as a founder, because having people that know kind of what's the norm and how this is going to work can make it much quicker to get your money in the door and into your bank account, and the negotiations much shorter. Expectations are just more well aligned. If you get someone, say a Wall Street type, who has a totally different conception of what preferred stock is, they look at it entirely differently, and you say, I'm going to sell you preferred stock under the Series C documents. I mean, it could be a very long road to closing, because they're going to look at those and say, well, this doesn't relate at all to what I'm accustomed to for terms of a preferred stock offering. So I think really focusing on your investors and whether you go
picking the right ones, right?
Yeah. Whether debt or equity, to me, is a little bit of a secondary issue compared to picking the right investors and making sure that people are really going to understand what the investment is and really be more supportive beyond just the dollars that they're putting into your bank account.
Hey, Todd, so when the note matures, what do professional investors suggest founders do? What's a professional firm like Wilson Sonsini suggest you do?
What we see most typically is an extension, and it's either explicit or implicit. A lot of the notes are only they're only callable if there's an action by the investors to call the note. So it can sit there.
They can do
and
nothing.
Be mature and do nothing, right?
I've seen people do nothing, which technically is an incorrect way to do it.
Not necessarily.
Is it not the most button up, or?
Well, it depends how the note is drafted. Oftentimes it allows for that. It says, once you hit maturity, if the majority and interest of the note holders decides to call the note, then it becomes due. Otherwise, it just hangs out there. You're past the maturity date, and it's just a risk. And you are
a risk for the founder. Really.
Right.
Exactly.
So it's in the founder's best interest
at any time
to
they can make that decision to call the note, which is a little bit of an uncomfortable situation if you don't have a great relationship with your investors.
I've had it happen like one time where like the company was doing so poorly that I was like, well, I guess they're not really getting back to us. The company had gone kind of AWOL. But in that kind of situation, a professional investor who's put 25 or 50K in writes it off and says, this isn't worth my bandwidth.
Right.
I mean, that's why it's, I think, good to get professional investors, because they would look at these kind of edge situations as not worth their time, I think.
I think that's exactly right, because you look at what are you going to do if you try to foreclose on the note? What's there? Oftentimes,
a domain name.
Yeah, a domain name. There's very little in the way of value in tangible assets. The IP is probably half-formed and not of much value without the founders there to implement on it. So most people just walk away.
You were going to add to that, Rachel? Yeah.
No, I mean, I think we spend a ton of time dealing with these particular issues, and I think it really is fundamentally what has happened, right? Because there's sometimes a moment where an investor might say, I'm going to double down. You're very close to hitting where you need to be, so I'm not going to call the note. And in fact, I'm going to give you a little bit more to get to that next milestone when then we as a group can go out and raise broader funds to support our next generation. But I think the key is what's the state of the company at that time? And then to your point, what's the type of investor, and are they going to have the appetite to manage this?
Okay, let's take another question here. This one's from Eric. How should I fire my co-founder? The most uncomfortable situation of all.
Yeah.
And it happens what? How often does it happen? 1 in 10?
So I mean, I don't know if we can ever really give them a perfect answer to this, because if they have truly formed the company, there's probably not going to be each can terminate each. I mean, it's kind of like a marriage, right? You don't just get to opt out.
Right.
How often does this happen? I mean, we probably see co-founder disputes, I don't know.
I'd say probably at least a third of the time.
Yeah.
Yeah, wow. So it's more often than people actually hear about. You probably only hear about it in the trades when it totally implodes.
Absolutely. And when it's a company that's real already.
Right. So how does it normally get settled? Do people start talking through the lawyers? Does the investor come in and play daddy or mommy and try to settle it?
The majority of the time, it's someone just deciding that they're not willing to commit to it, and they walk away. So very often it's amicable that one just says to the other, look, this isn't going to work out. I want to take a different direction. I'm not excited enough to be fully committed to this. And they just walk away. There are other times where someone has to be fired, and then it's a lot more contentious. And that usually, in fact, I addressed this about a week ago, where you get a bit of an uncomfortable call at 10 o'clock at night saying, hey, can we chat about my co-founder and what are the next steps here? And so then you have to counsel them. And it depends on the stage of the company. Is it a Series B company that has a professional board of directors and very methodical process that you need to go to? Or is it just two co-founders that you need to sit them down in a room and find an amicable way to separate and not ruin the company for the person that wants to stay and build it?
And for a company that has a board of directors, there's whatever 5 seats. That person might be one of the 5 seats. They're going to get voted off. It's corporate governance at that point.
That's right. That's right.
But if they don't have a board, there's no corporate governance in place, and you might just have a convertible note out there. Technically, legally, what happens? Is there a recourse?
When we form the company, there is corporate governance. It's just very basic. So there will be a board, and there will be a CEO, and that's part of what we have discussed historically about how do you form these companies, and why is it important to do it properly? Well, it's because you want a board of directors, and somebody needs to step up and take that CEO role. And so technically, the board hires and fires the CEO, and then the CEO hires and fires everyone that reports up to them. So you would go through a similar corporate governance exercise, but it may just be one person that you're dealing with, because there's one person that's the sole member of the board and one person that's the CEO, and then the co-founder is the CTO or some other role that they've chosen to take on.
And that's why it's so important that you do have that discussion at inception, right? Just to understand, hey, look, if your co-founder is the sole board member, or if your co-founder is the CEO, understand that puts you at risk. And obviously, we don't represent any particular one founder. We represent the enterprise, right? So we're looking at it from a governance perspective. Let me just explain to you how it works. We're going to put a board in place. You're going to have a CEO. You might be the CTO. But you guys just need to understand, right? Because everybody's best friends from college, and they're going to never, ever have an argument until they do, right? Yeah. And what our job is to just let them know how the landscape works, and the fact that understand that in 6 months' time, you may hate each other, and here's how this could play out. And as long as everybody's understanding of that, then it's okay.
When a person's being fired and they don't want to be fired,
right,
what is typically the settlement that would occur in one of these stage companies? What would the ask be, or what would the give be on the board or the co-founder? Mm-hmm. What would be amicable typically?
It's hard because it's very variant depending on who the people are, what the players are. I mean, so I'm in the process right now of negotiating exactly this, and the buyout's $250,000, right? That's more than most companies have raised in a year's time.
So they want to buy that person's shares back.
Exactly.
They don't want them on the cap table.
How do I get you out of this entirely? Right. But sometimes it might be, if there's any money at all, there might be some severance. There might be some negotiation of you haven't earned 25% of your stock, but I'll give that to you. You have to give them something to be able to walk, right? But also you don't want to give them so much that you've now hamstrung the company to be able to recruit new talent, which you're invariably going to have to replace.
Right. So if they had 40% and you had 40% and the investors had 20%, you're not going to vest them their 40% because then nobody will come work for the company.
Precisely.
Right? But somebody who is being fired could maybe hold out for that or try to cause problems, and that does happen from time to time.
And we've seen companies tank as a result of that, where there just is no agreement and someone's not willing to give up stock or is not willing to go peacefully, and as a result, the investors are like, I don't want anything to do with this, and it'll die.
So there is a self-correcting mechanism there. If somebody does go nuclear, the investors have more opportunities. So this is something important for founders to realize. If you put yourself in the bucket of unreasonable or unable to come to a reasonable solution between the 2 or 3 of you, this could result in investors scarlet lettering the company and just not wanting to be involved. It's just too much nonsense for their time.
Well, yes, that and any portion of their stock that they have vested in, the founder that's departing, they're just reducing any value that would have been there. So it doesn't really make a lot of sense. It's much better to resign, walk away, and go find your new gig. and try to keep those relationships. And maybe you get some value out of what you built while you were there. And we always, in order to avoid that from the investor issue perspective, try to get settlement and release agreements when someone's walking away. So I think that's
sign some paperwork.
Yeah, that's a tip for the founders that are staying, is always ask for that, because when you're raising money or selling the company in the future, if a large employee stockholder departed, any investor or buyer is going to say, did you get a release? Is this amicable? Can we be certain that they're not going to sue and claim that they're owed more? And that's the function of that release agreement. And that's, in order to get that, you need to give them some consideration. And that's why, as Rachel said, you'll often either give them cash severance or accelerate the vesting on some portion of their stock, just so you're giving them something of value in exchange for the release.
When I was younger, I always thought that these were legal issues, but the older I get, the more I realize they're just conversations between people that have a legal framework as a backdrop. It almost inevitably is settled just through a conversation amongst, hopefully, some reasonable parties in the room with the people who are being unreasonable. It never gets down to the legal actual issues, does it?
I mean, things have gone quite wrong if you need an arbitrator or a mediator or something like that. I think you're spot on that with a little bit of guidance, right, from an advisor, an investor, a counselor, whatever, they will be able to reach the right conclusion. But I think you're spot on. Most of the conversations can solve these things, and you don't need to get into the weeds and minutia. It's really just, it's often emotional, right? So if you can identify sort of what the pain points are. I don't want to be embarrassed that I got fired. I want to work on messaging. I want to make sure I can retain some value here because I want to ride what you're going to make a wild success. If you can solve for those things, again, often that's not totally legal. It's just more solving for the emotional outcome.
So Josh asks, how do I determine, and this is a great question that comes up often, how do I determine the valuation of my company? How does one determine the value of a company? Let's pretend this is a startup company in the first year.
Well, I think that the answer varies depending on why you're valuing it and what you're looking for.
Yeah.
So there are traditional investment banker methodologies like discounted cash flow, but most startups don't have any cash flowing, so that doesn't really work.
Discounted burn rate?
Yeah.
How much are we burning? Oh, the more you burn, the more you're worth.
So,
Some instances.
if you are looking at it from an option granting perspective, you will go out and get an independent valuation. It's called a 409A valuation based on a IRS tax code section.
These are like bankers do this, right? Like there's some like accounting firms that do a 409A valuation, and we have to do this because of the stock market crashing last time, or people are very attuned to this, it seems, making sure the 409A is correct.
Enron, actually.
Enron?
Yeah. It's all about
Mm-hmm.
senior executives that deferred their compensation so they wouldn't be taxed in the current taxable year. So they pushed it out into the future year over year over year to avoid paying taxes. And the IRS wrote regulations that cast a broad net to avoid that, which inadvertently picked up stock option grants. So in order to avoid having really, really nasty tax consequences when you're granting options to employees or consultants or other service providers, you really need to make sure that you have a 409A valuation in place.
And the lower it is, the valuation, compared to what the preferred shares sold for, typically people get in common, that's better for the employees because that's the price they're paying for the stock, and the gain they would get is what they sell the stock for.
That's right. And so it's interesting from a founder's perspective to, you almost want that to be lower because it allows you to more easily recruit, and people will be happy about a cheap exercise price for their options. Whereas when you're going to raise money, you want your valuation to be as high as possible. So they're a little bit counter to each other. And in that context, the investors will set the valuation. You should be thoughtful about what percentage of your company you're willing to sell for what amount of funds. But,
so this gets to the second stage, which is I'm not giving options to employees and co-founders. I'm giving options. I'm selling shares to an outside investor.
Right.
In the market today, in 2015, going into 2016, when we're taping this right before the holidays, what do people? How do people typically figure out the valuation? Do they look for the angel investors to put a value on it? Do they suggest it themselves? Does the angel suggest it? How does it typically work today?
I find that it's usually the investor that sets it. But again, I think that the founders, entrepreneurs should have an expectation. You don't want to go in blindly not understanding how this is going to impact the capitalization and dilute you. But it's kind of the buyer who will set the terms. And for those guys, it will vary quite widely. They'll look at comps, what are other similarly situated companies selling stock for. And then, frankly, I think oftentimes they'll back into a valuation. They'll say, I have X dollars that I'm willing to invest, and I want to own Y percentage of the company post-closing, and so we can back into the valuation pre-money.
How does this negotiation typically go down, Rachel? Like if people can't figure out, the expectations, like we see so many of these companies coming out of some incubators with very high expectations because of previous high valuations. It seems to have tempered itself of late, where things have come back down.
Right. I mean, I think we've all watched, especially some of the public displays of people thinking that the market's overvalued many of the private companies. So I think that's kind of helping level set things. I agree with Todd entirely, which is it is absolutely a negotiation. And I think for better or for worse, a lot of it depends on the players in the negotiation, right? If you're a first-time entrepreneur who has no real track record and may not come from the best breed of whatever it was, like it may be harder for you to drive a high valuation than someone who's on their second or third startup and is just, everyone's clamoring to put money to work there.
So if there's a marketplace and there's competition for the deal, the value is going to go up, obviously.
Absolutely. And I think the other point, which is to underscore, it's not really on you to set your own valuation. And in fact, it is on you as a founder to go out and be doing a market check, right? You should talk to a handful of investors and kind of get a level setting to say, if I need to raise $5 million, how much of the company are you willing to buy and am I willing to give up? And you should do that serially so you actually understand what the true, demand curve looks like, because you may just be, frankly, wildly uncertain about the way your company stacks up. Everyone believes their company is worth billions of dollars until they go out and market check it, and then they have a little bit of a reality set. And I think it's important to do that because it is, at the end of the day, a series of negotiations where you have to land on something that both investor and founder are comfortable with, or no one's happy.
Yeah, the way I typically handle today is I ask them what they're looking for, what would be their ideal situation. They tell me, and then I say, explain to me based on that valuation how you are going to return 100 times my investment, because that's my goal, is to have 100x return, or at least in every company to have the chance at 100x return. So if somebody asks for a $10 million valuation, I say, okay, well, explain to me how this business becomes a $1 billion business. How much top line revenue, what's your bottom line have to be to hit that? How would you? And it's amazing how many haven't gone through that exercise.
Right.
And a lot of times I ask people, do they have a lead and who the lead is? And they don't have a lead. What are your thoughts around leaderless companies in the last couple of years, where we have, some people call them party rounds, where there's no board, no individual investor is more than 10% of the round, and there's basically no governance. I know we had, I was an investor in a company called Circa, and Matt, who ran the company, just gave a talk, and he said one of the things he regrets most was that they didn't have a really big, they had no board, and they thought that was cool until when things hit the fan, there was really nobody who cared enough to really fight to keep the company going. They didn't really have a support structure.
Yeah, I mean, I think you hit the key point. I mean, there's some element of leadership that's necessary. And again, a party round may be perfect for some companies, and it might be perfect for some seasoned entrepreneurs who sort of know what they're doing. But I think one of the biggest value adds of a lead, right, regardless of if it's an angel lead or a typical firm lead, is that they truly can add perspective and value to the building of a business, right? And they have ownership in it, because usually, something greater than 10% in a round, I mean, that's going to give them some skin in the game, and they are going to help you through the hurdles, and they are going to help you navigate. Again, this goes back to picking the right partner. So I think there's a time and a place for the group rounds, but I honestly think that most companies really benefit from some leadership, some governance, some
When should they have a board, Rachel? When do you suggest people start to put a board in place with outside directors or investors, not just the founders? So,
I mean, I think Series A for sure. Again, what Series A means is also a moving target these days.
A couple of $1 million.
Couple $1 million, absolutely. When you've got real money that you need to manage, and you're starting to grow beyond just your core founding team. Because again, I think it's better not to be in your own echo chamber, right? If Todd and I are co-founders and all we're doing is listening to each other, that's probably not going to produce as good a result as if we had a third person to just be a sounding board. So I think, a couple $1 million, Series A for sure.
What about doing it earlier when you have a convertible or you're just on your seed or angel round? Because I've started to think and advise my incubator companies to start boards earlier, proactively, and to just get an independent or somebody they really love on that board, and to just start holding, a board meeting every other month, even if it's very light, not, super heavy hitting, but just to get themselves into some sort of cadence around governance. What do you think of that idea that I've been suggesting?
I think it's a really good idea. And I think the reason that you even have to propose that to entrepreneurs is that there has been this trend towards leanness for leanness sake, and having very pared down governance and total control in the founders, which in certain circumstances is appropriate and it's just fine. But there's an awful lot of value that you can get out of mentors and board members and people that will help you. And I think that we should look at this whole governance ecosystem as something that could and should be beneficial to the founders, and that they can help them grow and help them grow their company. I mean, it's a hard thing that these people are doing. And I think we've been taught that the sole founder, that's the way to go. Maintain control as long as you can, and I think that's sometimes to the detriment of bringing in people that can be really supportive and helpful. So I don't think there's a one-size-fits-all solution, but I think doing it earlier could be really good for a lot of companies.
I'm going to mandate it to my incubator companies because, you know what, and not that I'm on the board or I have any seat, just that they have a board of like 3 seats, 1 independent, the 2 founders, and they just start doing a board meeting so they have something to look forward to every 60 days to sort of become a waypoint in the history of the company.
And the accountability piece that you mentioned, I think, is a really important one as well, because if they don't have that kind of cadence and the thoughtfulness of I'm presenting to someone else and I need to make sure that I've got everything in order and that I'm thinking clearly, if that isn't part of the regular discipline, it's going to be very difficult to flip on a dime once they've taken in a big check.
Yeah. It's fascinating how many companies there are today. What do you think of the number of companies there are in the ecosystem versus the number of investors? Your business has gotten really, I know you guys are super busy because we work on things together and you're slammed all the time. I'm slammed all the time. Is this sustainable, this number of companies? Because we've all been in this business for a long time. I've never seen it this active, but I've also never seen this much revenue coming into certain companies. What's your take on it, just on a personal level, how active Silicon Valley is in 2015 going into 2016?
I think there will be a lot of companies that fail over the next few years, and I don't think it will be awful. I think there are companies that aren't standalone businesses that they will get bought, or people realize that and decide they want to go do something else. But I think they will have been trained well, and it'll be a great experience. So I do think that we will see a bit of a slowdown, but I think that at the core, there are more really amazing companies being developed today. And I think those companies are going to go on to do really great things. So I see it as a natural weeding out of companies that really weren't meant to be long-term standalone businesses. And I think that'll be good ultimately for the ecosystem.
What are your thoughts on the expansive field we're seeing?
I think we have to remember part of the reason that that's happening is just because it's the cost of starting a company is so much lower than it has ever been historically. And so by definition, there's so many more market entrants. And I agree that just by definition, that doesn't mean for every new company there's a new investor that enters the space. And as a result, not all of those companies are going to grow up to be successful. I think the good news, and Todd highlighted this, is that many of these are developing features that other companies will be interested in. They'll be nice little tuck-ins. They'll find their way to maybe merge with each other. But there's so much innovation, and inspiringly so. I think that trend will continue. But again, I think we will definitely see companies fail, and I don't think that means that we won't have another onslaught of tons of companies in 2016, but I think we'd have to be mindful that that's just going maybe our new norm, right? Lots of companies, lots of failures, and still some great pieces that get pulled from the rubble.
I think getting used to small failures and gigantic wins is going to be what we're all going to have to consider the new norm. You might on a name basis have 7, 8, or 9 out of 10 as an angel investor fail. But boy, when they do hit, you're going to start talking about hundreds or thousands of X returns. So it's a very interesting psychological phenomenon to go through. I know for myself, just dealing with so many different companies, investing in 30, 40 a year, you get a lot of phone calls from people who are in a panic and their companies are going to shut down. And then you don't get the phone calls from the people, like Travis and Marco at Thumbtack and Travis at Uber. Like, they don't need to call me because things are going so well. So you actually wake up thinking, my God, everything's going really poorly, until you actually do, an assessment of the portfolio, an assessment of the winners, and the winners greatly outstrip the returns of the losers. So it's a very exciting time, isn't it?
Yeah, well, and I think it's highlighted by the different conferences that you do. You have launch, and then you have scale,
right.
And they're different hard things to do, and so different people excel in different areas, and I think you'll see that in the companies as well.
Not everybody makes it to the next conference.
Yeah,
it's basically I made a conference to help my portfolio companies. I literally was like, if 50 people come and talk about just growing them, and I provide the service for them to go and hear 54 speakers talk about growing, I'm trying to really find opportunities for them to learn how the growth occurs. Because people do tend to get caught up in this, what I call the feature death march. They just want to work on the next feature. They never think about the growth. Mm-hmm. And the bandwidth seems to become a real issue with these venture capitalists. The number of VCs is static. The number of companies is dynamic. We got a real logjam in seed, a logjam at A, logjam at B. Everything's just a line around the corner to get these rounds done.
Yeah, that's true.
It's going to be a very interesting couple of years. All right, listen, we could talk for hours. So many issues. You guys did a great job of taking complex topics and making them digestible. Thanks to Rachel Proffitt and Todd Carpenter of Wilson Sonsini, WSGR.com, and Wilson Sonsini on Twitter. If you have more questions, you can just tweet them to @TWI Startups. You can follow the show, TWI Startups, on Twitter, on Instagram. You can follow me on Twitter and Instagram. I'm @Jason, JASON. That's my obnoxious way of saying I have premium accounts. It's always fun when you're at a party and people are like, what's your Twitter handle? I'm like, Jason. Yeah. They're like, okay, yeah, Jason _what? Yeah. Like, no, just Jason. All right, listen, great job, guys, and we'll see you next time on This Week in Startups. Bye-bye.